Okay, thank you for tuning in again. This is the video, Simple Explanation of Your Illinois Property Taxes, Part B, a simplified tax example. Now in Part A, we talked about reviewing your assessment statement and reviewing your property taxes. But if you're still not 100% familiar with how that whole tax mechanism works, and when I talk about that, I talk about this mechanism right here, where the tax levies are determine the total assessed values of the properties, and then the tax rate. Then we have just a really basic example to kind of show you how it works. And then we'll talk about how your taxes might go up using this particular example. So this is what we're going to do. Just a simplified tax example where you have an area with just 300 residences, 100 condominiums, 100 townhomes, and 100 standalone homes. Now, businesses pay into taxes too, but we're just going to keep it simple here. Then we have three main tax levies: schools, police, and the fire department. So now we're going to go through that four-step process, just doing these three sets of homes and these three tax levies. The first step is, of course, determine the tax levies. So let's just say the school board determines a levy that they need $700,000 next year. We know that, in real life, that is millions of dollars more, but right now we're just keeping it to 700 grand. Then the fire protection district, they need a levy of 350,000. And the police also need a levy of 350,000 for next year. So the total tax levies is 700 grand plus 350 plus 350, $1.4 million. Then the next step, determine the total assessed value of the homes. So let's say your local assessor now, for condos, let's just say that they determine that each condo is worth 75 grand in fair cash value. Now the assessed value of that is 1/3, so 75 grand divided by 3, 25 grand. So the total assessed values for all the condos is 25 grand times 100, or $2.5 million. Now we know in real life, no condos or no townhomes or any other examples here will have the exact same amount. Everything differs, but we're just doing this for simplicity's sake. Now let's look at townhomes. Let's just say the assessor says each townhome is worth 150 grand in fair cash value. So the assessed value would be divided by 3, or 50 grand. So the total assessed value for all townhomes is 50 grand times 100, or 5 million. Then homes. Say each home is worth 300 grand in fair cash value. So the assessed value is 300 grand divided by 3, or 100 grand. So the total assessed value for the homes, the standalone homes, is 10 million. So the total assessed property value for the area is $2.5 million plus 5 million plus 10 million, or $17.5 million. So now the county clerk determines the property tax rate for this area. So the tax rate again, total tax levies divided by total assessed property. So let's just look at it for each individual levy. For schools, 700 grand divided by 17,500,000 equals 0.04, or 4%. Or police, 350 grand divided by 17,500, 0.02, or 2%. And then fire, 350 million divided by 17.5 million, 0.02, or 2%. So now the total tax rate, schools is 4% plus 2% for police plus 2% for fire. Your total tax rate is 4% plus 2% plus 2%, or 8%. So this is just a really simplified version of what you're reading in the lower left-hand side of your property tax statement. Where there, of course, you have the county, your local schools, conservation district, that type of thing. But here it's just going to be 8%. So now fourth, calculate your tax bill. So now the tax bill, again, is the assessed value times the tax rate. So for a condo, $25,000 assessed value times 8% equals $2,000. Townhome, 50 grand assessed value times 8%, $4,000. And then a home, $100,000 assessed value times 8%, $8,000. So this is basically how a tax bill is determined in the most simplistic form. So now if you reverse calculate this, you'll see that it comes up to $1.4 million. So 100 condos times 2 grand per condo is about 200 grand. 100 townhomes times 4,000 per townhome, 400 grand. 100 homes times 8,000 per home is 800 grand. So the total in taxes, 200 plus 400 plus 800, $1.4 million. Now we're going to kind of use this example to answer the question, how do your taxes change? Or in lots of cases, how do your taxes go up? And it's actually one of four ways. First is the most obvious one. The taxing districts raise their levies. Then there's the second one. Your home assessment is raised higher than other homes around you. Or third, there's a change in the number of homes in your taxing district, typically a rise in the number of homes. Or four, a combination of the above three factors. And quite frankly, number four is the most common case. So let's look at this example. Let's say for taxing districts raise their levies. Okay, assuming all other factors stay the same, such as home values, number of homes, etc., taxes can go up from raised levies. However, Illinois law states taxing districts cannot raise their levies higher than the Consumer Price Index. Now, per the U.S. Department of Labor, the Consumer Price Index is a measure of the average change over time in the prices paid by consumers for a market basket of consumer goods, such as milk or vegetables and services. So if the Consumer Price Index was just 2% from one year to the next, taxing districts can only raise their levies no more than 2% higher than the previous year. The only way they can raise them higher is through a public vote or a referendum, such as if they have to build a new school. So let's just go back to the original example. Let's just suppose that the school district and the police increase their levy 2%. So 700 grand times 1.02 for schools, that's 714 grand. Police, 350 grand times 1.02%, 357 grand. So now your total tax levies are 1.421 million. So now let's calculate the updated tax rate. So now for schools, 714 grand divided by 17.5 million goes up 4.08%. Or fire, 350 grand divided by 17.5 million, it stays the same, 2%. But police, 357,000 divided by 17.5 million, 0.02 or 2.04%. So now the total tax rate goes up 8.12%. And then you calculate your tax bill. And if you'll see a condo, now if you calculate it through, their tax bill went up $30. Townhomes, it went up $60. And homes went up $120. So now another way your taxes can go up is where home assessments go up higher than So another way your taxes can go up is if your home assessment goes up higher than other home assessments around you. If your home gets a higher assessment raise than other homes around you, your tax bill will go up. So again, like we were discussing in part A, it is key to review your home assessment, not just to make sure that your home is valued properly, but also that it is valued uniformly with the same homes around you. So, for example, if homes in your area start selling at a higher price than homes in other areas, your tax bill could rise. So let's go back to the example again and show how this could happen. Suppose for a quadrennial, assessors raise the value of townhomes from 150 grand to 195 grand fair cash value based on sales data. So now the assessed value of a townhome goes 195 grand divided by 3, and that's $65,000. But let's just also suppose that condo values and home values remain flat. I know in a real world, that's not going to be the case, but we're just doing this for this example. So now the total assessed value for all the homes goes up to about $21.5 million. And now look at the tax rate. For the schools, 700 grand divided by $21.5 million, it drops to 0.0325 or 3.25%. Fire, it drops to 1.63%. Same with police, 1.63%. So now calculate the tax bill. For a condo, because the tax rate has dropped, 25 grand times 6.5%, now the tax bill is $1,625. It dropped $375. But the townhome, because again, the assessment was raised, 65 grand times 6.5%, $4,225. So it actually went up $225. And for a home, 100 grand times 0.065, $6,500. It actually dropped $1,500. So this is how, if your assessment goes up compared to others, how that can affect other people's tax bills. Now, what about equalizers? Because again, In a non-quadrennial year, a county can apply an equalizer, but it should be noted that within a township, equalizers are applied the same to all homes, whether they be condos, townhomes, standalone homes, that type of thing. However, you should note that if your home shares tax levies with another township, that's where your tax bill can be affected. So let's say in Township A is given an equalizer of 1.07. The new assessment for the next year would be 100 grand times 1.07 or $107,000. So 107,000 times, let's just suppose that the tax rate was 8%, that would be 8650. But Township B has an equalizer of just 1.05. So the new assessment would be 100,000 times 1.05 or $105,000. So the new tax bill there is $8,400. It's actually $250 less just because of a lesser equalizer. But again, anything within a township is applied uniformly in terms of that equalizer. Now, another potential way that your tax bill can change is when there is a change in the number of homes within your taxing district. In most cases, especially if you're out in one of the collar counties of Chicago, hopefully the number of homes is actually increasing in your taxing district, such as new developments, new condo towers, new apartments, those types of things. Now, new homes might actually cover any particular tax increases, and we'll show you how that's done. So, for example, let's just suppose, like say for the first part, suppose your total tax levies went up 2.5%. So 1.4 million times 1.025, the total tax levies are now 1.435 million. However, a condo building with 10 more units was added, and 10 more homes were built. So now your total assessments, and this is just assuming that the home values stay the same, your total value of assessed property is about $18,750,000. So the tax rate is 1.435 million divided by 18,750,000 or 7.6%. So it's dropped. So now the tax bills would be a condo, 25,000 times 7.6%. It's actually dropped $100. Townhome, 50,000 times 7.6%. It's actually dropped $200. Or just a regular home, assuming that it's $100,000 again, times 7.6%, that actually dropped $400 from our original example. So that sounds great. However, it should be noted, in cases like this where you have a lot of development, there can be a longer term issue. I mean, more homes and a higher population means what? A larger demand for schools, you have to hire more teachers, perhaps put up another building, more police, more infrastructure. So the issue is sometimes if growth in population or home building doesn't outpace the growth in tax levies, tax burdens will still rise on each individual homeowner. But the fourth issue is that there's a combination of those three factors. Tax levies can rise or fall, and home values can also rise or fall, and the number of homes in a taxing district might not increase. For example, in 2008, remember when the market crashed? Home values plummeted and assessments dropped, but tax bills rose. Why? Part of the reason is that new homes were not being built. In fact, there were several years where maybe just a handful of homes were being built in each town. So what happened? Existing taxpayers were shouldered with larger tax burdens. And there are other factors for taxes too. Commercial and business, of course. More receipts from businesses, such as through sales taxes, means less of a tax burden on property owners. In fact, part of the reason the village of Schaumburg, in the northwest suburbs of Chicago, part of the reason they built Woodfield Mall, it was built in part to prevent Schaumburg from levying property taxes on their residences. Then there's also factors such as pensions or debt. We can certainly discuss those, and that would mean that this video would be about 6 or 7 hours longer. But these are all factors going into your property taxes. So how do you keep your property tax bills the same or lower them? There's actually three main ways. Okay, first is actually to go to public meetings when they set the budgets and they set the tax levies and voice your opinion. Because then a lot of times, the people on these boards aren't someone living in a tower away from them. They're your neighbors. They're people that you see at the store. And if you go to a meeting and voice your opinion saying, I don't want this raised, hopefully they go back to the drawing board. Another is, of course, appeal the assessment of your home if it is too high. Now, more on that, of course, in Part C. And then another way, and this sounds incredibly naive, I know, this is the state of Illinois, but one way is to run for office. I'm not talking about for a senator position or local representative position, but the people that are on these school boards or perhaps are on these townhome boards or county boards, some of them are really bad at their job and really bad at managing a budget. And they actually need smart people to properly manage a budget and properly manage a levy. And if you think you're qualified from that, that's one of the things you could potentially do. So that's the end of part B. For part C, making an assessment appeal, click on the I shown above, or if you're watching this in the playlist, just stay tuned. Thank you again.